Welcome to Making Money, a special update. The Fed, the markets, and what it means to you. It's Friday, June 17th, just 2 days after the Fed raised interest rates by 75 basis points, the largest increase since 1994. What you need to know about everything that just happened in the last few days, coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. This is Making Money. It's a special Friday update, as I promised I'd bring to you. It is the Fed, it is the markets, and more importantly, what all this means for you and your money, your portfolio, not just today, but going forward. So we have a lot to get to. It's going to be a quick 8 to 10 minute really recap and look ahead of what's going on. But let me recap really quickly what happened with the Fed on Wednesday. The Federal Reserve raised interest rates by 75 basis points, as I just mentioned earlier. It is the largest increase that we have had since 1994, 28 years, folks. So very big increase, and it really didn't catch the market too much off guard. A week prior, there's basically zero chance that was going to happen. Everybody thought it'd be 50 basis points, which is 0.50%, ended up being 75. That brings the Fed funds rate in between 1.5 and 1.75, so we call it 1.62%. Now let's break down some of the stuff that the Fed had to come out here and say. Fed Chairman Jerome Powell came out and said the reason that they pivoted from 50 to 75 was because of the very hot CPI inflation reading, which I've talked about several times in the past show. So that was the pressure that pushed them to raise interest rates higher to try to calm down the inflation that we're dealing with right now. Looking ahead, Chairman Powell said he does not see 75 basis points being the norm in meetings going forward. There's another meeting in 6 weeks from now, but did say, depending on what inflation numbers are and how the market's reacting, there could be another 75 basis point, but likely between 50 and 75 is what we will see. He also came out and the Fed gave their projections for 2024. What was kind of funny about that was he also came out at some point, it might have been during the presser or during his statement that he read, but I think it was during his statement, he mentioned that nobody can really tell where the economy is going. Nobody has a crystal ball, yet they give their projections out to 2024. They now believe the GDP, the gross domestic product, the growth here really in the United States for this year, 2022, now coming in at 1.7% versus the estimate of 2.8% at the March meeting. So they think that growth is slowing in the economy here in the U.S. Also lowered growth expectations for 2023, 2024. The PCE, which is the Fed's inflation reading, they expect it to fall to 5.2% by year end and down to 2.2% by 2024, which is really right in their range. If that is the case, that's fantastic. I don't know. And again, very tough to look out that far. So the Fed also said they believe that the Fed funds rate, as I just mentioned, at 1.62 right now will be about 3.4% by the end of this year, up to 3.8% in 2023, back down to 3.4% in 2024. So basically what they're saying is between now and very early of next year, so about 6 to 8 months, let's call it, will be the peak of them raising interest rates. And I can go along with that because I think at that point you will see inflation start to come down, especially if the economy slows down a little. Which typically will happen when you see interest rates go up, as we're seeing right now. And that will then equate to the Fed being able to take the foot off the gas and letting the economy figure things out. Keep in mind, I'll talk about stocks in 1 second. Typically, stocks will price in a recession, price in this stuff happening way before. And that is why the NASDAQ's down 30%. It's why the S&P went into a bear market. So thinking now that, okay, we could potentially go into a recession, and if we do, it's going to be a very, very shallow recession, in my opinion. A lot is priced in, if not all of it. So again, we can continue lower. I said a few weeks ago that this market, I picked several stocks that I thought hit bottoms. And I looked at a lot of stocks today that I like, and they didn't break back down to a new low like the market did. So there's a lot of stocks that are being very constructive underneath. At the same time, the overall market still looks like it's on shaky ground and could have some more short-term weakness before we find a bottom. I had said weeks ago that 3,400 to 3,600 in the S&P 500 could be a level we're going to look at. Down around 3,600 and change today. So we'll look at that chart here in 1 second. One other thing I want to talk about, going back to the CPI number real quick, that make up 54% of CPI. That is food, energy, and shelter. Those are kind of the necessities that we have. We have to eat. We have to have shelter somewhere. We don't have to, but we would like to have shelter somewhere. And then energy. Most of us use energy either in our cars, to heat our home, cool our home, whatever it might be. Energy is a big player as well. But I saw the really great article talking about services less energy, and this would be kind of big ticket items, everything from shelter is included in there, but paying for your dog bill, pay veterinarian, paying car rentals. That makes up 57% of CPI, and over the last 12 months, that's up 5.2%. So that's one we feel as well. It may not be exactly into the energy and food, but those are also items that we do feel. So let's take a look at some of these asset classes and how they're doing. And number one, we're going to take a look here at the S&P 500. As you can see, we've fallen to new 52-week lows. And this is Friday morning. It's about 10:22 Friday morning, so about 50 minutes or so into the market. We are up about 0.5%, 0.7% in the S&P. We're now in the low of the session, down 0.5%. So the selling continues. This day right here was a Fed day. We actually rallied on it. Then we got spooked afterwards, thinking that the Fed's going to be overly aggressive, and it fell big on Thursday. Now Friday, continuing that sell off, and that's not good action, folks. Like I said, there's going to be at some point with this capitulation. Here's a chart of the Nasdaq 100, which is more tech related, still up 0.25%, but again near the lows of the session. Now let's take a look at the VIX, which is the CBOE Volatility Index. You can see we're up near levels that we've spiked in the last year or so, up in the mid 30s. We're now down around 31 and change, but we came close to that. I was saying, you could tell I'm back in the Florida studio. I just got back last night from Nicaragua, but I was talking to a lot of people down there, a lot of people interested in the economy and the market, obviously, and saying that I think the VIX could hit 40, had this somewhat of a capitulation before we kind of bottom out here. And if we zoom out on the VIX, I'm going to show you something. For the most part, we had that 40 back in 2020. Again here, this was obviously the COVID spike, very much an anomaly. That's not what we're seeing here. That's a kind of a very much a black swan one-off event. We also had a big spike back in 2018 as well, very, very quick. And then end of 2018 is a little bit more of what we're seeing now. And that was concerns over China back then. But again, so that 40 level tends to be a point where in normal times, and not that anything's normal or not normal, but without some type of quick reaction to something that came out of nowhere, this we've been talking about for a while. So I think around this 40 level, we should be able to see hopefully that be the capitulation at that point. A few other things I want to take a look at here. Let's take a look at gold, because many of you like gold, think gold's the best inflation hedge. And you can see gold really hasn't moved up as inflation's, really continue to move higher. And it's down today 0.75%. I don't care about today, but it's been going sideways and has not been acting, in my opinion, the way it should be acting when it comes to the way that we're seeing inflation be so hot, 40-year highs. Now, how about the U.S. dollar? So the U.S. dollar index, this is the UUP. This is something you can actually buy. This is an ETF that tracks the U.S. dollar index. So it's U.S. dollar versus a basket of several other large currencies. And as you can see here, up today about 1.2%. It's a big move on this, but the trend has been much higher. And it looks like that trend is going to continue because as the Fed raises interest rates, it makes it more attractive for people to buy bonds here, more money coming into the US dollar. So that's not too abnormal to see that. And that has been a great hedge. And a lot of people say to me, well, nothing's going up, Matt. Nothing's going up. I get that. But that is one way to hedge. And what I'm going to do on Tuesday's show, I think is really important to talk about some ways if you are truly, truly concerned that inflation is going to continue, this trend will continue. Again, nothing is a buy or sell recommendation, but I'm going to put together a few hedges for you that if that's what you feel, here are some ETFs and here are some stocks that you can protect your portfolio. Not just, as I'm saying, going short, but other asset classes that have been doing well. I'm going to highlight some of those for you on Tuesday. And a couple other charts I want to take a look at before I talk about the bond yields here. And this is a very interesting one. This is from Bespoke, and this is shows a 60-40 portfolio, folks. If you don't know what that is, that's a old school way of kind of allocating your money. 60% into stocks, 40% into bonds, and typically this tracks the S&P 500 and the long bond, the U.S. Treasury. So as you can see here, this is the second worst period ever since the 1970s, and this shows 6-month returns, and it's down. Look how big this is, big double digits. The only other time we had that down this low, a few times it happened back in 08, 09, which of course was a great financial crisis. Even worse than we saw back here. And this was the sell-off from the tech bomb. bubble. Then you see here in 1987, we had that big sell-off, Black Monday, bigger than that. So what this chart is showing me, folks, it's saying that there's nowhere to hide, because if you think you're in bonds and a bond fund and a bond ETF and you're doing well, you're not, because they're getting crushed as well. And I'll show you a chart of that here real quick. If you're looking at, just saying, well, I'm going to buy the TLT, I'm going to invest in U.S. Treasuries. Look at this chart, folks. This is a chart of the iShares Barclays 20 plus year Treasury bond ETF. And it has gotten absolutely decimated from a high in early December around 154. It fell below 110. Now it's at 111. But you are down big. I mean, big, big, big. And it's only paying a little over 3% yield. So there hasn't been a lot of places to hide out. And I've been talking to so many people in my travels the last couple of weeks, and people are ready to give up. And I hate to hear that. But at the same time, when I hear that, I want to let people know that it's okay. We're all feeling this pain. And it's happened time and time again over decades of the stock market. This is normal. Recessions happen, bear markets happen, but what you can't do is you can't change your complete strategy, because if a strategy has been working, it's going to continue to work again when the market turns back around. So I want you to keep that in mind. And another way that this is affecting you as well, which I think is very important, is the housing market. Look at this, folks. This is the bank rate 30-year fixed rate mortgage rate. This is going back to 1998. Look at that spike. So this is really slowing down the housing market, which will probably see housing prices come down due to that. And what's going to equate from that is you're going to see inflation come down, because shelter prices will come down. And this just shows the week over week change. And see, it's near the high. This is a very, very high level, the week over week change that we have seen here. So again, I just want you to show you just how this is affecting everything from mortgage rates to bonds to stocks. And one more chart here I'm going to show you. This is the AAII, American Association of Individual Investors, the bull bear spread. And when it's a 4-week moving average below -10, we've only had this one other time, going back to 89, 90, actually 91, sorry, early 91. This again just shows the bearishness, the negativity that people have right now towards the economy, towards the market. And, I hate to see that, because I want us all to be positive. But at the same time, this keeps telling me, again, I'm not calling a bottom here. I think we could have one more swoon down. But when I look at individual stocks, there's a lot of individual stocks that I will keep saying that have bottomed already, that did not break back down with the market. And I think there's a lot of great opportunity for people to have 3 to 5 years, if longer, be even better. But if you have a 3-year, 5-year time horizon, as Jeremy Siegel of Wharton said last week, you will not be unhappy if you bought now, if you had a 3 to 5 year outlook. I happen to agree with him on that. I think there's some great opportunity right here. And as far as the Fed's concerned, raising interest rates like this, typically stocks do okay in a rising interest rate environment. It's not true that they get crushed. And again, we've priced in a recession. We've priced in higher interest rates. We've seen the 10 years shoot up. Everything's been priced in the near term. Could things get worse? Yes. I don't know. I don't have a crystal ball, but we've priced in nearly the worst, where at this point, the downside is so much lower than a huge upside potential again in the next 3 years. So stick with your guns, invest in strong companies. I'm not saying it's run out by today, but what I'm saying is get that watch list ready and start little by little. Don't be a hero, put it all in at once. Little by little, get in the market. And again, if you're worried and you see, your portfolio going down, it's okay. You're in the same boat as probably 99% of people out there in the market. It's not just you. It's part of a market cycle. It's like anything else in life. It's a roller coaster. Nothing goes straight up. We go up and down. But as long as we keep trending higher, which we have been doing for over a century, and I believe there's no reason to believe we won't continue to do that, you want to stick to your guns and have a great weekend. Forget about this darn market for the weekend. Enjoy your family, friends, get some sun. Whatever makes you happy, get out there, hug somebody, tell them you love them, smile and spread that love, because that's very important as well. And the stock market will be here next week when we reopen. So again, folks, thank you so much. I hope you enjoyed the quick special update. Have a great, wonderful weekend. We'll see you next Tuesday. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.